Hey folks, welcome back to day 53 of the Storage 100 series. I am Joe Downs with the Storage Mastermind, and today we're diving into net operating income, or NOI, the true north of commercial real estate. And remember, NOI is not just the number, it's the heartbeat of your investment, and it tells you the real profitability of a property before financing it. Understanding NOI is crucial for making smart decisions. It's the foundation for evaluating any commercial property. We lightly touched on it the other day, but today we're diving in. And we'll break down the formula and explore why it's so important. Folks, this is the metric that separates good deals from great deals. So let's get into the nuts and bolts of NOI. NOI, simple formula with profound implications. It's your gross income minus your operating expenses. And it's a clear picture of a property's operational efficiency. Critical point most people miss. NOI does not include debt service, which means it shows the property's performance independent of how it's financed. And this allows for an apples to apples comparison between different properties. We're going to explore each component of this formula in detail because understanding this formula is your step to mastering commercial real estate valuation. Again, it's a simple calculation, but it's so powerful for valuation. So why does NOI matter so much? Because it directly drives your property's value. Your NOI divided by the market capitalization rate gives you the property's value. So let's use an example of $100,000 of NOI. At a 6 cap, that would put a value of your property at $1.66 million. And this shows you the incredible leverage of NOI. Every dollar you add to NOI increases your property's value significantly. Even a small increase in NOI can lead to a substantial jump in valuation. And this is why optimizing operations to boost NOI is so critical. It's not just about the cash flow, it's about building equity. Okay, so let's break down what makes up that all-important gross income. Because when we talk about income, we're looking at all of the revenue streams of a self-storage facility and all of the streams of revenue that it generates. Of course, rental income being the foundation, the primary driver of your gross income. But don't forget about the other significant contributors like late fees and admin fees. They're important revenue. Merchandise sales, if you're selling them, like locks and moving supplies, also boost your top line. And then you have things like tenant insurance is another key income stream that often gets overlooked. Maximizing each of these income sources directly impacts your NOI. So every dollar here flows down to that crucial NOI figure. Now, let's talk about what's included in those operating expenses, the cost of running your facility. Property taxes are often the biggest expense, so keep a close eye on them. Insurance is another significant cost you need to factor in. And management fees, whether they're in-house or third-party, are also part of your operating expenses. Utilities, like electricity and water, operating expenses. While repairs and maintenance keep your property in top condition, they are operating expenses. And of course, your marketing efforts are necessary to attract and retain tenants, operating expenses. And then, of course, payroll, if you have staff, is a key operating expense. So we've covered what's included in NOI. Let's talk about what's intentionally left out of NOI. And we sometimes mix these up, and sometimes sellers mix them up. That can be good or bad. These are what we call the below the line items. These are what does not go into the NOI. They're expenses. They're not expenses in operating expenses. They're expenses of the facility. But they're items that don't factor into property's operating profitability. So, for instance, mortgage payments, both principal and interest, are excluded, not included, excluded from NOI because they relate to financing, not operations. Capital expenditures, or you hear us throw the term around CapEx around, like a new roof or paving, are also what we call below the line investments. They're not recurring expenses. Usually they're one time. Depreciation and amortization are accounting entries, not actual cash flows or cash outflows. And finally, income taxes are specific to the owner, not the property's performance. So understanding these exclusions helps you focus on the true operational health of a storage facility. So let's compare two different ways of looking at NOI and why one is much more reliable than the other. So building on that understanding of NOI, we need to distinguish between what we call the trailing 12 or T12 NOI, and when you're evaluating a facility to purchase, the Proforma NOI. This distinction is crucial because it highlights the difference between reality and projection. The trailing 12 or T12 NOI represents what actually happened historically. This is what we want to use to buy. This is the hard data, the verifiable truth, what banks rely on for lending decisions. Pro forma NOI, on the other hand, is the seller's vision of what could happen in the future. It's often an optimistic projection, and sellers frequently use it to justify a higher price. You always remember, banks lend on reality, but sellers try to sell on fantasy. And this brings us to a common tactic sellers use to inflate their property's value. Because now that you know the difference between T12 and Proforma, you should be able to see the common tricks sellers use to manipulate NOI. So things like watch out for adjusted NOI figures that remove legitimate expenses. One classic move is removing management fees, claiming, well, I manage it myself, so it costs zero. But you will need to hire a manager. So that's a real expense you'll incur. Another trick is ignoring tax reassessment. They might use the current low taxes instead of the higher taxes you'll pay after purchase. Sellers might also hide maintenance costs by burying repairs and CapEx to artificially lower operating expenses. These manipulations create an artificially high NOI, which then leads to an artificially high price. It's really important to scrutinize these adjustments to avoid overpaying for a property. All right, let's wrap up with a final thought on the importance of NOI. To bring it all together, remember this simple truth. NOI is your scoreboard. It's the clearest indicator of a self-storage facility's financial health and potential. Your goal is always to increase revenue and decrease expenses because that directly translates into wealth. Focus intently on the NOI. It's the ultimate measure of your investment success. By understanding and optimizing NOI, you're setting yourself up for significant returns. This focus on NOI is what separates successful investors from those who struggle. All right. If you found this information valuable, please hit the like, subscribe, and share buttons. As you know, this helps us reach more people who are serious about self-storage investing and joining our community. Sharing this content also lets your network know you're in the game, which can be helpful for future capital raises when you find your first deal. So go ahead and share this because you might spare someone in your network from making a costly mistake by not understanding NOI. And they will thank you later.